Vanguard ran the math. They published a paper. And what the paper says is that you can convert a traditional IRA to a Roth when your future tax rate is lower than today's rate and still come out ahead. Not because of a loophole, not because of a spreadsheet trick, because the rule most people are using is missing 3 variables that quietly determine everything. And one of those variables can flip your answer completely without changing your tax rate at all. The paper also identifies a specific scenario where ignoring this framework, even while following the simple rule correctly, can trigger surprise Medicare surcharges, accelerate Social Security taxation, and cost you more than the conversion itself was supposed to save. Here's what I find genuinely amusing about this. We're talking about one of the most consequential financial decisions a 50 or 60-year-old will ever make. A decision that can't easily be undone. A decision with a 30-year compounding tail. And the guidance most people are walking around with is a 2-sentence rule they absorbed from a coworker, a 3-minute YouTube short, or an advisor who moved on to the next client 15 minutes into the meeting. Higher rate later, convert. Lower rate later, don't. Done. That rule is not wrong. It is dangerously incomplete. And in this video, I'm going to walk through exactly what Vanguard's BETR strategy actually says, what it means for your specific situation, and the 3 levers that most people never look at. The 3 levers that determine whether your conversion is a smart move or a tax bill you didn't need to write. Let me give you the whole thing through something concrete, because abstract tax talk is where attention goes to die. Imagine a toll booth, an actual physical one. The kind that existed before Easy Pass made us all slightly lazier about basic decisions. You have 2 options. Pay the toll now and drive through free. Or use a deferred payment system and pay when you exit. Both roads go to the same destination. The only question is which option costs less total. A traditional IRA is the deferred payment lane. You drive through now and pay when you exit in retirement. A Roth IRA is the prepaid lane. You pay up front, you ride free forever after. Most people understand this. What most people don't understand is that there are 3 distinct lanes on that deferred side, and which lane you choose to pay from changes the effective cost of that toll dramatically. The toll booth operator doesn't explain this. Your HR department definitely does not explain this. And most financial advisors are pointing you toward whichever lane they can explain in the time they have. The BETR, the break-even tax rate, is the exact number where both options cost the same. If your expected future tax rate is above that number, the prepaid lane wins. If it's below that number, the deferred lane wins. Clean enough, except the BETR number itself moves, depending on factors that have nothing to do with your tax bracket. That's the thing. That's the whole game. And I want you to hold that toll booth image in your head, because I'm going to come back to it every single time this gets abstract. In a few minutes, I'm going to show you the exact scenario where someone in a 35% bracket today should convert even though their future rate is only 24%. But first, here's why the lane you use to pay the toll, not the amount, is the most underrated variable in this entire conversation, and why most people never even think to ask the question. Everyone who has ever thought about a Roth conversion has asked themselves the same question. What will my tax rate be in retirement? That is the question. That is the whole framework. And it makes sense. If you are going to pay tax now instead of later, you want to pay at the lower rate. Logical. Human brain approves. And this is precisely the kind of clean, logical framework that leads smart people directly into expensive mistakes. Here's what nobody is telling you at the typical financial planning appointment. The BETR, the actual break-even number, depends just as much on where the money to pay the tax comes from as it does on what rate you pay. That is lever number 1, and it is the one that most people blow past completely. Say you convert $100,000. You're in the 22% bracket. The tax bill is $22,000. Where does that $22,000 come from? Option 1, you pull it straight out of the IRA itself. You convert $100,000, withhold $22,000, and $88,000 lands in the Roth. Less money growing tax-free forever. Option 2, you pay the tax from a taxable brokerage account, an index fund, sitting in a regular account. The full $100,000 moves into the Roth. You've drained your brokerage account by $22,000, but the entire converted amount is now compounding tax-free. Option 3, you pay from a tax-inefficient taxable account. Think of a bond fund throwing off taxable interest every single year. Money that is already costing you annual tax drag, sitting there doing its inefficient little thing. Here's what Vanguard's research shows. When you pay the tax out of the IRA itself, your break-even tax rate lands roughly equal to your current rate. Makes sense, you lost IRA dollars to fund the bill. When you pay from a tax-efficient brokerage account, the BETR drops below your current rate. More money flows into the Roth and the math tilts in your favor. When you pay from a tax-inefficient account, a bond fund, something generating heavy annual taxable income, the BETR can drop even further. Because now you're stripping money out of a high-drag environment and loading more into a tax-free one. Two problems solved simultaneously. One, conversion. The toll isn't the only cost. The lane you pull the money from changes the total price of the trip. This is where a lot of retirees get stuck. They look at the bracket comparison, they run the simple calculation, and they completely skip the question of which pocket is funding the tax payment. That single oversight can cost you the equivalent of several years of compound growth. I have sat in enough conversations with accountants over the years, spent a decade running my own business surrounded by tax professionals who thought about money structurally, not emotionally. And the which pocket question is the one that separates a genuinely useful tax planning conversation from the kind that leaves you feeling informed but slightly worse off. Now, here's where it gets really interesting. There's a woman in Vanguard's research paper. They call her Jill. Jill is in the 35% bracket today. She expects to be in the 24% bracket in retirement. The old rule says, future rate lower than current rate, skip the conversion. Straightforward. Jill should sit on her hands, put the calculator away, move on. Jill does not sit on her hands. Jill pays the conversion tax on $100,000 using her taxable brokerage account, separate money, outside the IRA. The full $100,000 moves into the Roth. Vanguard runs the math over 20 years. And they find that Jill's break-even tax rate, her personal BETR, is approximately 23.3%. Her expected future rate is 24%. That is barely above the break-even, but it is above it. The conversion helps her. Jill's future tax rate is 11 percentage points lower than today's rate, and she still wins the conversion. That is the entire reason this video exists. The simple rule would have told Jill to do nothing. Vanguard's math says Jill comes out ahead by acting. The difference is the BETR calculation and the lane she used to pay the toll. By the way, hit subscribe if you're finding this useful. Otherwise, YouTube's algorithm may never show you my videos again. And this channel specifically exists to read the documents most people don't read. SEC filings, earnings reports, research papers with footnotes nobody opens and tell you what actually matters. Now I want to introduce someone, not Jill from Vanguard's paper. Call him Uncle Dennis. Dennis is 68 years old, retired from the Postal Service, living in Ohio. He spent 32 years contributing to a traditional retirement account. He retires at 65 with $420,000 in a traditional IRA. He reads some articles, he talks to a friend at his golf club who did some conversions and feels great about it. Dennis decides to convert $200,000 in a single calendar year because he's genuinely convinced correctly that once his required minimum distributions kick in at 73, his taxable income is going to climb. He followed the simple rule correctly. Higher rate coming, so convert. He does. He pays the tax from the IRA, he gets the Roth, he tells his wife things are under control. Then the Medicare bill arrives. I'll come back to Dennis. But I want you to hold that image, a retired postal worker at a kitchen table staring at a Medicare premium notice that doesn't match anything he was told to expect, because that image is going to mean something very specific in about 4 minutes. Here's the second lever. And this one is genuinely underappreciated in almost every mainstream conversion conversation. Basis. Specifically, after-tax basis sitting inside a traditional IRA. Here's how basis gets in there. Some years, your income is high enough that you can't deduct a traditional IRA contribution. But the contribution limit still allows you to put money in, you simply can't deduct it. So you make a non-deductible contribution. You've already paid income tax on that money going in, it grows inside the IRA. But when it comes out, the IRS only taxes the growth, not the original contribution. That original after-tax money is your basis. Not everyone has basis. A lot of people have zero everything in their traditional IRA as pre-tax, but plenty of people in their 50s and 60s have been making non-deductible contributions for years, especially once their income climbed high enough to phase out the deduction. And the tracking of that basis reported on IRS Form 8606 is something a genuinely alarming number of people have lost track of entirely. Here's why basis matters for the BETR. When you convert a traditional IRA that includes basis, the conversion is not fully taxable. The pre-tax portion gets taxed, the basis portion converts tax-free. You move money into the Roth without writing a full check to the IRS on it. Vanguard's research shows that the higher the percentage of basis in your IRA, the lower your BETR drops. In their charts, at 50% basis, the break-even tax rates drop dramatically compared to a 0% basis account. The more after-tax money sitting in there, the more attractive the conversion becomes on pure math, even when the rate comparison looks unfavorable on the surface. What does this mean practically? If you have been making non-deductible IRA contributions, and you track your basis on Form 8606, a Roth conversion is materially cheaper than the face value tax rate suggests. That basis is yours. It lowers the cost of moving money into a better structure. Don't convert without knowing if it's there. And if you don't know whether you have basis, pull your tax returns. Look for Form 8606. It may be sitting there quietly on a document you filed 12 years ago. You think the problem is finding the right tax rate to compare, but actually the problem is that you don't know how much of your own IRA you've already paid tax on. Now, before I get to lever number 3, let me give you a one-line summary of what most financial TV gets completely wrong about Roth conversions, just to set the stage. Picture a segment on a morning financial show. 2 minutes of camera time, cheerful music. The host asks, "So when should someone do a Roth conversion?" The advisor smiles and says, "Great question." Basically, if you think your taxes will be higher in retirement, it makes sense. If you think they'll be lower, probably hold off. The host nods. Fantastic. Thank you so much. Cut to commercial. Somewhere, a 63-year-old with $40,000 of after-tax basis and a bond fund full of drag writes down, "Convert if taxes go up," and puts the notepad in a drawer. That is where this conversation has been living. And that's why Vanguard published a paper with the word break even in the title, lever number 3. And this is where the BETR strategy stops being a one-time comparison and becomes a multi-year planning architecture. High-income earners above certain thresholds can't contribute to a Roth IRA directly. In 2026, the income phase-out for Roth contributions begins at $150,000 for single filers and $236,000 for married filing jointly. Above those lines, the door closes. But there is a completely legal workaround that has existed since 2010. You make a non-deductible contribution to a traditional IRA, no income limit on contributions, only on deductions, and then you convert it to a Roth shortly after. Almost no growth has occurred in that short window, so the conversion is effectively tax-free. This is the backdoor Roth. The problem, and it is a real one, is the pro rata rule. If you have existing pre-tax money in traditional IRAs, the IRS does not let you convert only the after-tax basis and leave the pre-tax money behind. They blend everything together proportionally. If you have $90,000 of pre-tax IRA money and $10,000 of after-tax money, then 90% of any conversion is taxable, regardless of what you intended to convert. The backdoor Roth stops working cleanly. Here's what Vanguard's framework reveals about this interaction. If you convert or roll out that existing pre-tax IRA money, first clearing the deck entirely, you open up clean backdoor Roth contributions for potentially years or decades afterward. When you add those future years of tax-free compounding into the analysis, the BETR for that initial conversion drops significantly. In some of Vanguard's scenarios, to only a few percentage points above zero. Think about what that actually means. You might look at a conversion in your late 50s and conclude, my expected future rate of 18 or 20% is below the BETR, so this doesn't pencil out. But when you factor in that this conversion enables 5 or 10 years of clean backdoor Roth contributions that compound indefinitely tax-free, the initial conversion starts looking completely different. You're not paying a tax bill. You're paying an entry fee for a much better account structure that will run for the rest of your life. Which lane are you in? That is the question. And you have to know your lane before you calculate the toll. There is a financial advisor somewhere. This is not a hypothetical. This is a personality type that exists in large numbers who has been reciting the 2-sentence rule for 15 years. Higher rate later, convert. Lower rate later, don't. He is extremely confident. His clients trust him. He has a nice laminated chart for the wall, and he is leaving measurable money on the table for virtually every client by missing these 3 levers. Not because he is incompetent, because the simple rule answers the question quickly and gets people most of the way there. The problem is that most of the way there in retirement planning means close enough to feel okay while being measurably worse off than you needed to be. That gap tends to show up in your 70s and 80s when you can't do anything about it. Stay with me, because this next part changes everything. Back to Dennis. Dennis converted $200,000 in 1 calendar year. He was correct that RMDs would likely push his future rate higher. He followed the simple rule exactly as intended. But the simple rule did not know about IRMA. IRMA is the income-related monthly adjustment amount. It is the Medicare surcharge system that increases your Part B and Part D premiums when your modified adjusted gross income crosses specific thresholds in a prior year. In 2026, the standard Medicare Part B premium is approximately $245 per month per person. Cross the first IRMA threshold and that number climbs. Cross the second threshold and it climbs further. At the higher brackets, a single person can pay $428 or even $594 per month instead of $245. The IRS uses your income from 2 years prior to set the premium. Dennis's $200,000 conversion spiked his modified adjusted gross income for that tax year and pushed him into a significantly elevated IRMA bracket. That cost him an extra $3,400 in Medicare premiums the following year. Gone. Not in the rate comparison, not on the simple rules checklist, gone. And then it compounds, because higher modified adjusted gross income also means more of his Social Security benefit is subject to income tax. Below $25,000 in combined income for a single filer, Social Security is effectively tax-free. Between $25,000 and $34,000, up to 50% of the benefit is taxable. Above $34,000, up to 85% is taxable. Under normal circumstances, Dennis was nowhere near those thresholds, but his conversion income pushed him deep into the 85% zone. His Social Security benefit was $22,000 per year. With the conversion, roughly $18,700 of it became subject to income tax. That is a cascading effect. The 2-sentence rule has no mechanism for predicting. Dennis followed the simple rule. He followed it correctly, and he still lost thousands of dollars in costs. The rule never counted. Now here's the part Dennis figured out 2 years later, working with a fee-only planner who ran the full multi-year analysis. Spreading that same total conversion over 3 years, roughly $65,000 to $70,000 per year, would have kept his income below the critical IRMAA thresholds. It would have kept his Social Security income largely out of the taxable zone. The same money would have moved into the Roth, a fraction of the side effect cost. The full conversion goal achieved with a dramatically better total outcome. The BETR framework would have suggested exactly this from day one. Not because it's smarter, because it asks more questions than the simple rule does. Let me show you what this looks like with a realistic scenario from a different angle. Imagine a man named Robert. He is 62, recently retired from a sales career in Georgia. He has $480,000 in a traditional IRA. He has roughly $45,000 in a taxable brokerage account, mostly held in a low-cost S&P 500 index fund with mostly unrealized long-term gains. He also has approximately $22,000 sitting in a bond fund in a separate taxable account. It throws off taxable income every single year automatically. He has no basis in his IRA. Everything went in pre-tax. His expected retirement income from Social Security, part-time work, and portfolio withdrawals is around $60,000 per year, putting him in roughly the 22% federal bracket going forward. This year, his first partial retirement year, his income dropped significantly. His effective marginal rate is approximately 12% on his last dollar earned. The simple rule says, Current rate 12%, future rate 22%, convert now. And that is correct. But the BETR framework tells Robert considerably more. If Robert converts $100,000 and pays the $12,000 tax bill from his bond fund, pulling that high drag taxable money out and funding the conversion tax with it, two things happen at once. $100,000 moves into a tax-free Roth account, and Robert eliminates $12,000 of bond fund that was generating taxable income every year and would have continued doing so indefinitely. His BETR drops below 12%. The conversion is even more attractive than the simple rate comparison suggested. Now Robert checks the IRMAA thresholds. In 2026, the income level where the first IRMA surcharge kicks in for a single filer is approximately $106,000 in modified adjusted gross income. Robert's base retirement income is $60,000. A $100,000 conversion pushes his total income to approximately $160,000, well into the second IRMAA bracket, adding roughly $2,400 in extra Medicare premiums the following year. So Robert doesn't do $100,000 this year. He does $50,000. That keeps his total income around $110,000 above the first IRMA threshold, but comfortably below the second. He does $50,000 the year after. Same calculation. Over 4 years, Robert completes roughly $200,000 in conversions, moves from the 12% rate window to the 22% window gradually, avoids the upper IRMA brackets, and never fully tips his Social Security into the maximum taxable zone. The BETR framework didn't just tell Robert whether to convert. It told him how much, in which order, and from which pocket. That is the actual tool. That is what the paper contains. Required minimum distributions are the pressure building in the background of all of this. Traditional IRAs and most 401k plans force distributions starting at age 73 under current law. The required percentage increases as you age. By 78, the required withdrawal from a large IRA can push a moderate income retiree into a tax bracket they never expected to reach. By 83, even larger. And these are mandatory withdrawals, whether you need the money or not, whether the market is up or down, whether your health expenses are high or you've had a quiet year. Roth IRAs have no lifetime required minimum distributions for the original owner. 0. The money grows indefinitely until you choose to take it or until it passes to heirs. That structural advantage does not show up in a simple rate comparison. It shows up in your late 70s and 80s when you discover that your traditional IRA has grown large enough to generate mandatory taxable income that you never budgeted for, pushing you into brackets that trigger IRMA, that push more of your Social Security into the taxable zone, that narrow your flexibility at precisely the moment when flexibility has the most value. There's a retired teacher, a real type of story that tax professionals tell in fairly specific detail, who converted a large portion of her IRA in her first year of retirement because her advisor applied the simple rule correctly. Good intentions, correct application. She spent the next 3 years in an elevated IRMA bracket, paying approximately $1,800 per year extra in combined Part B and Part D premiums, a total of $5,400 that nobody on either side of the table anticipated because the income check wasn't part of the standard workflow. $5,400. Not from a bad investment, from an incomplete checklist. The system finds a way to collect. That is not cynicism. That is just a very complicated machine that the government assembled over decades with no single architect, where optimizing one variable while ignoring the adjacent ones costs you in ways that don't show up until the bill arrives. So here is the practical framework. I'm calling it 3 lanes and a map because that's what this actually is. Lane 1 is where the conversion tax money comes from. A taxable account with high annual drag is the best lane you remove money from a structurally inefficient pocket and load more into the Roth simultaneously. A tax-efficient brokerage with mostly unrealized gains is the second lane decent, better than pulling from the IRA. Paying directly from the IRA itself is the last lane, not wrong, but the least efficient use of the conversion. Lane 2 is basis. After-tax money you already paid tax on, tracked on Form 8606. Every dollar of basis in your traditional IRA lowers the effective cost of a conversion. Find it before you convert. It's yours. You already paid tax on it once. Lane 3 is the backdoor path. If clearing your pre-tax traditional IRA enables multiple years of clean backdoor Roth contributions, run the multi-year math. The door you open downstream changes the value of the toll you pay today. A conversion that looks marginal in isolation can look obviously correct when you add 5 or 8 years of annual tax-free compounding from clean backdoor contributions. And the map always run the IRMA and Social Security income test before executing any conversion. Identify the exact modified adjusted gross income thresholds for the current year. Calculate what the conversion adds to your total income. Decide whether the full conversion fits below the critical thresholds, or whether a partial conversion this year, followed by one next year, is the smarter sequence. One calculation. Enormous consequences if skipped. I want to be direct about something, because I have some real money invested, and I'm not speaking from theory here. The decisions made between age 60 and 70 are substantially less reversible than the decisions made at 35. At 35, a suboptimal investment decision costs you some returns and time bails you out. At 65, a Roth conversion decision executed without the full framework locks in a tax structure that compounds consequences for 30 years. The asymmetry of what's at stake should determine the quality of thinking you apply. Most people apply the same quality of thinking to both. That mismatch is where the real cost lives. Vanguard manages $8.7 trillion in assets as of early 2026. They are not publishing a research paper to drive conversion business. They run passive index funds and have essentially no direct stake in this question. They published it because the simple rule was leaving measurable money on the table for millions of people who had done everything right and deserved a more complete answer. When Vanguard writes a paper that complicates the conventional wisdom probably needed complicating. Which lane are you in? That is still the question. And the answer is not the same for everyone. The answer depends on where you're pulling payment from. Whether you have after-tax basis tracked on Form 8606, whether clearing your traditional IRA opens up a clean backdoor path, and whether your conversion income will cross an IRMA threshold or accelerate Social Security taxation in the year you pull the trigger. Uncle Dennis figured this out. 2 years after the expensive conversion, he's now doing partial conversions of $50,000 per year, calibrated carefully below the IRMAA thresholds, keeping his Social Security largely outside the maximum taxable zone. He won't fully undo year one's damage that bill was paid, but his picture going forward is clean. The thing is, had Dennis had the BETR framework from day one, the expensive year never happens. The partial strategy was always the right answer. The simple rule never told him that. 3 things to actually do, not general retirement wisdom, specific to this framework. First, identify your payment lane before running any conversion math. Look at every taxable account you have and assess the annual tax drag. Bond funds, actively managed positions, money market accounts generating ordinary income, those are your best payment sources. Using high drag taxable money to fund a conversion improves your BETR on 2 fronts simultaneously. This is not complicated to check. It takes 1 hour. Second, find your basis. Pull every tax return from the last 10 years and look for Form 8606. If you ever made a non-deductible IRA contribution, the cumulative basis is on those forms. It is a number that directly reduces the taxable portion of any future conversion. Do not run a conversion analysis treating your entire traditional IRA as pre-tax if any portion of it isn't. You already paid that tax. Don't pay it again. Third, before executing any conversion in any calendar year, run the modified adjusted gross income test. Calculate your expected base income for the year, Social Security, pensions, portfolio income, part-time work, add the conversion amount, then check where that total lands relative to IRMA thresholds and the Social Security taxation cliffs at $25,000 and $34,000. If the conversion pushes you into a higher IRMA bracket, the question becomes, does splitting this conversion over 2 or 3 years preserve the tax benefit while eliminating the Medicare surcharge? Usually yes, often dramatically so. The BETR framework is not a new loophole. It's not a clever workaround. It is a more complete set of questions applied to a decision that most people were answering with a 2-sentence rule that was written before anyone thought carefully about basis, IRMA, the Backdoor Roth, or the compounding interaction between RMDs and Social Security taxation. The math was always there. Vanguard named it and put the variables in a single framework. Lazy investing built more fortune than crypto memes. And the guy promoting crypto memes still has a fully loaded traditional IRA, no idea what IRMA stands for, and a Medicare premium notice sitting unopened on the kitchen counter.